The rate of inflation we're seeing now in 2022 may appear alarming to many of us. After all, if everything's getting more expensive, you must make do with less, right? No, not always. If home prices are rising quickly, for instance, whether this is good or bad depends on whether you are buying or selling a home. Price increases are advantageous to sellers. When inflation increases and property prices rise as a result, buyers suffer. In general, people who own real assets like performing stocks, real estate, and precious metals can rise with the inflation tide during times of high inflation. Even if money doesn't grow on trees, it can increase with prudent saving investing methods. One of the most crucial life skills you'll ever require is understanding how to safeguard your financial security. You don't need to be brilliant to accomplish it. Only a few fundamentals, a plan, and a commitment to following through are required. Whatever your financial situation, it's crucial to educate yourself about your opportunities. Perhaps looking for a chance to make prudent investments can be beneficial during this time of high inflation we are experiencing. In this video, we will be bringing to your knowledge of the factors that contribute to inflation and the ways in which astute investors can profit from it without seeing their purchasing power diminish. Welcome to our channel. Please make sure to hit that like and subscribe button so that you won't miss any brand new ideas of investment from us. Grow with us financially. A rise in price for goods and services across some or all economic sectors is what is known to be inflation, which is defined as an increase in the money supply. Different inflationary situations exist today in this economic environment. Let's find out what they are. Wage push inflation. Rising labor costs are the cause of this wage push inflation. Cost push inflation. Cost push inflation is a result of increasing labor and material expenses, as well as a decline in the aggregate or total supply. Demand pull inflation. The additional demand brought on by these inflated prices causes prices to rise. Hyperinflation. In hyperinflation, monthly price rises that are out of control typically exceed 50%. Prices may rise sharply each day in a severe hyperinflation, to the point where the currency is essentially useless. Stagflation. When an economy with rising prices experiences slow or no growth and a high unemployment rate, stagflation may result. Negative inflation. Deflation is another name for negative inflation. When prices for products and services decline, this is called deflation. The rapid decline in prices is known as hyperdeflation. Investigating the potential causes of increased pricing is the key to comprehending them. Understanding the underlying reasons of price inflation aids in deciding whether risk reduction and inflation hedges are necessary, as well as whether some investments can be more profitable as a result of inflation hedges. Nah, you cannot choose a suitable investment on your own unless you have a basic understanding of what is claimed to be the parameters for estimating inflation. Consumer Price Index. The tool used to gauge inflation is the Consumer Price Index, or CPI. It is used to calculate the typical difference in pricing of household goods between two specified periods. It is an overall assessment of product pricing trends while maintaining quality. It appears in the official journal each month. The CPI is used to compare a number from one era to another. The inflation rate is the difference from a prior month, quarter, or year. It is important to keep in mind that the Consumer Price Index does not measure the cost of living. The consequences of price changes on the purchase costs of the goods that families use are what the Consumer Price Index aims to quantify. The Cost of Living Index, on the other hand, aims to gauge changes in the cost of goods and services needed to keep household standards of living at a given level. The Producer's Price. The producer's price is the sum that the producer is owed by the buyer for each unit of a good or service produced as output, less any VAT or other deductible taxes that the producer has separately invoiced to the buyer. it does not include any transportation costs. The supplier's retail and wholesale margins, as well as separately invoiced transportation and insurance costs, are also not included. The basic price of a product plus any non-deductible taxes that the producer paid on the product, less any subsidies that the manufacturer received on the product, is the producer's price. Purchasing power. It is determined by how many goods or services one unit of the said currency can be used to purchase. Inflation may cause it to deteriorate over time. This is due to the fact that you may acquire fewer items or services as a result of increased pricing. It is also known to be the currency's buying power. When referring to investments, purchasing or buying power refers to the dollar amount of credit that a customer has based on the marginal securities that are currently in their brokerage account. The purchasing power of the US dollar has increased by almost 96% since 1913. The same items that could be purchased in 1913 with $1 cost around $26 in 2020. Interest rate. An interest rate is the portion of the principal that the lender charges for the usage of its funds. The loaned sum of money is known as the principal. The price of loans is impacted by interest rates. They can therefore make the economy grow or shrink. To promote the best possible economic growth, the Federal Reserve controls interest rates. As the Fed increases interest rates, this could be an inflationary move that will result in higher pricing for numerous items because borrowing costs are a necessary component of almost everything. But if the money supply expands quickly enough to overheat the economy, this could also lead to inflated prices. In such a situation, the Fed might be tempted to hike interest rates in order to slow the economy down. In order to make it simpler for investors and producers to manage the inflationary risk with an inflation hedge and build the economy based on historical performance, the Fed prefers to keep a stable and low inflation rate around 2%. Investors ought to consider low-risk investments with returns that outpace inflation. Now for the finest guidance on how to earn profit out of rising inflation. 8 ways to shelter your money right now are exclusively provided for you. Real estate. Due to the potential increase in property value during times of rising inflation, real estate typically performs well. As a result, your landlord will be able to raise the rent they charge you, raising their income to keep up with the rate of inflation. Real estate investments can be undertaken through REITs, sometimes referred to as real estate investment trusts, or through mutual funds that invest in REITs in addition to house ownership. However, the post-pandemic period might alter how real estate reacts to greater inflation. Fundamentals are somewhat in doubt due to COVID's long-term effects, according to Arnott. As more businesses adopt remote work or hybrid models, demand for commercial real estate such as office and retail spaces is still unstable. Tips. Treasury inflated protected securities are referred to as TIPS. TIPS are actually pretty simple to understand, despite the fact that the name may seem intimidating. Government securities known as TIPS track changes in inflation. Therefore, the interest rate paid increases along with inflation, and when there is deflation, interest rates decrease. Since TIPS are indexed to inflation, they can help balance out your fixed income or bond portfolio, according to Dearhan Lassus, managing principal of PPAC Private Wealth Management and a CFP. TIPS are among the safest investments you can make since the US federal government backs them. TIPS are also a great way to diversify your portfolio and supplement eventual retirement income. According to Amy Arnott, a portfolio manager at Morningstar, the price of TIPS helps protect against these unforeseen increases in inflation because it rises in step with the Consumer Price Index, which is a gauge of consumer prices paid over time. TIPS, she tells Select, are by far the best inflation hedge for the common investor. TIPS bonds are issued in maturities of 5, 10, and 30 years, and their interest is paid twice annually at a predetermined rate. Investors are paid the greater of the adjusted principal or the original amount at maturity. Cash. Cash is frequently disregarded as an inflation hedge, according to Arnott. Cash is not a growth asset, but it will typically maintain pace with inflation in nominal terms if short-term interest rates are growing at the same time as inflation, she continues. The CEO and founder of Dare to Dream Financial Planning, Anna N.J. Conte, concurs. N.J. Conte advises constantly holding some cash in a high-yield savings account, money market account, or certificate of deposit, given how unpredictable the economy can be, as the pandemic has demonstrated. She continues, having too much cash is a risk to people's finances that is underappreciated. For homes with one income, N.J. Conte advises saving enough money for 6 to 9 months, while for households with 2 incomes, she advises saving enough money for 6 months. Until we have a better knowledge of what longer-term CDs entail, Lassus advocates keeping your short-term CDs. Short-term bond. A short-term bond investment strategy is akin to keeping funds in a savings or CD account. Your money is protected and available. Additionally, short-term bonds are more resilient in the event that rising inflation raises interest rates, whereas long-term bonds will experience losses. Because of this, Lassus advises avoiding anything long-term oriented and sticking with short to intermediate-term bonds. In order to be less affected if interest rates rise quickly, she advises choosing shorter-term bonds or bond funds. As bonds mature, investors can also reinvest in short-term bonds at greater interest rates, says Arnott. Inflationary performing stocks. Stocks can be beneficial as a long-term inflation hedge, but they may suffer in the short term if inflation increases, according to Arnott. When investing in performing stocks, you must carefully consider where your money should be placed because sectors and the top stocks within those sectors are always changing. The objective is to buy shares of market-leading companies during bull markets and sell short shares of market-leading companies during bear markets. This can be accomplished by tracking the top-performing stocks within each sector over time and selecting the sectors that have had the most growth during a bull market. By consistently shifting funds into the top-performing stocks, you have a strong chance of earning returns above average. Investors typically prefer growth momentum stocks, which are currently profitable businesses with the ability to raise prices on their customers, to value stocks, which pay dividends and have lower PE ratios. Additionally, investing in international or multinational company stocks can have the added benefit of increasing the value of the currency relative to the dollar, since inflation is often measured in a single currency, such as US dollars. It's simpler than ever to start investing if you're new to the field. You must first create an account with a brokerage or trading platform in order to do this. To uncover the finest solutions for novice investors, Select analyzed more than a dozen internet brokers that provide zero-commission trading. The best stock brokerages for free trading offer the most diverse selection of investment options, user-friendly technology, excellent customer support, and educational materials. Precious metals. Investing in precious metals is a wise approach to diversify your holdings and hedge against inflation. The most well-known of these is gold, but other options to consider include silver, platinum, and palladium. While each sort of precious metal has advantages and disadvantages, they are generally sound investments. Without actually possessing any metal, you can invest in precious metals. The market for derivatives, the purchase of equities in mining firms, and the use of metal ETFs and mutual funds all provide access. Commodities. Oil, metals, and agricultural products are examples of raw materials whose price typically rise in tandem with inflation, making them effective hedges against it. However, investors should be aware that commodities can also be incredibly dangerous, says Arnott. The relationship between supply and demand, which can be very unpredictable, heavily influences commodity pricing. In addition to investors using leverage, this makes them a dangerous investment because there is a great potential for rewards but also a high potential for losses. Cryptocurrency. Bitcoin is frequently referred to as digital gold, and in theory, the limited supply should prevent inflation. However, whether it will serve as a solid long-term inflation buffer is still up for debate, according to Arnott. Arnott also mentions the recent volatility of Bitcoin as a caution to investors. If anything, she claims that it underlines how challenging it may be to include Bitcoin in a balanced portfolio. Still, we can't forget to mention the pros and cons of investing during inflationary times. In order to account for inflation, investment techniques must be modified. The objective of an investor should be to outperform inflation in terms of return on investment, or ROI. Otherwise, the value of the investor's portfolio is decreasing. For instance, when inflation is more than 1%, as it is now, depositing money in a bank account for a low-return bank CD that pays less than 1% interest annually is a losing proposition. The bad news is that each year, the difference between inflation and the investor's return on investment erodes the real value and purchasing power. An investor's portfolio should be reviewed in light of inflation to make sure it is balanced, diversified, and contains investments that will outperform any unfavorable consequences. Pros: investors with long-term fixed-rate debt, such as a mortgage, profit from inflation. Consumption is encouraged now rather than waiting until later when prices might be higher due to inflation. Increased commodity prices could be beneficial to individuals who trade or sell them due to high inflation. By using tangible assets that maintain long-term value, such as gold and other precious metals, vintage wines, antiques, fine art, and real estate, one can enhance investments as a strong hedge against sudden inflation. Owning these may allow you to profit from inflation-driven price increases. Cons: a rising economy with a consistent annual increase is indicated by a low, stable inflation rate. As a result of inflation, every dollar now will be worth less tomorrow. Currency depreciation and increased exchange rate risks are results of inflation. When the Fed and the US government react to inflation, the stock market, real estate, and many other investments could suffer. When costs are higher, there is less of a desire from consumers for luxury products and other discretionary things. Inflation makes it more challenging for those with fixed incomes, such as pensioners, those with disabilities, or the elderly, to cover living expenditures. Unpredictable, out-of-control hyperinflation could bring down and destroy an economy.